Hello! Today we will be covering the weighted average method for calculating cost of goods sold and ending inventory. On the right, I have a list of transactions that the company was involved in, including purchases and sales. On the left, I have a chart where I will show my work as I complete this problem. There are three columns I will be filling out. First, we have purchases, which we will use only when the company purchases new inventory. I have a plus sign here because new purchases add to our inventory. The next column is cost of goods sold, and we will use this column anytime the company sells some of its inventory. I have a minus sign here because sales subtract from our inventory. The third column is inventory, which is where we will keep track of how much inventory the company has as of the given date. We need to add to the inventory column anytime there is a purchase, and subtract from the inventory column anytime there is a sale. Our first piece of information is from January 1st. The company had 500 units of inventory, which they had previously purchased at $10 each. Since these units are part of beginning inventory, we can place them in the inventory column. Now, some instructors will have you calculate the inventory balance at this stage, taking 500 times $10. But in this video, I'm going to wait until the end to do any of those kind of calculations. Next, on January 2nd, the company purchased 300 units at $11 per unit. Since this is a purchase, we can put it in the purchase column. Since there were no sales on this date, we can skip the cost of goods sold column. We always need to fill out the inventory column, and this is where the weighted average method is going to differ from other inventory costing methods. Under any other method, we would separately list each inventory layer in the inventory column. But when we use the weighted average method, we want to list all of our inventory at one cost, and we need to calculate a new cost per unit every time there is a purchase. In this case, the new cost is going to be somewhere between $10 and $11, and maybe a little closer to $10 since we have 500 units at that cost, whereas we only have 300 units at the $11 cost. The way we find the new cost exactly is by taking the total value of our inventory before the purchase plus the total value of the purchase divided by the total number of units. So in our case, that's 500 times 10 plus 300 times 11, that whole quantity divided by 500 plus 300, which equals $10.38. So that means we have 800 units at $10.38 per unit. The 800 units comes from the 500 we had in beginning inventory plus the 300 units purchased. Now, different teachers will have you round the cost differently, but for our purposes, I will be using 2 decimal places. Next, on January 7th, we have our first sale of 640 units. That means we get to use our cost of goods sold column. Since the column is titled cost of goods sold and not price, we can't use the $35 selling price here. Instead, we have to use the weighted average cost that we calculated in the previous step. So on January 7th, we record 640 units at $10.38 per unit for our cost of goods sold. As for the new inventory balance, since cost of goods sold subtracts from our inventory, we take the previous inventory balance of 800 units and subtract the 640 sold on January 7th to get 160 units in inventory, still at the $10.38 per unit. Remember, we only need to calculate a new cost per unit each time there is a purchase. And since there were no purchases on January 7th, we can keep the $10.38 cost the same. On January 11th, we sold 120 more units. Since we made a sale, we will be using the cost of goods sold column. Again, we can use the cost of $10.38 since all of our inventory has been averaged at that same cost. Now for our inventory column. Remember, cost of goods sold is minus, so we take the 160 units in inventory minus the 120 units sold to get 40 units in inventory. Next, on January 19th, we have a purchase of 400 units at $13 per unit. Since we have a purchase, we can record these units in the purchase column. Moving on to the inventory column, remember, when using the weighted average method, every time we have a purchase, we need to calculate a new cost per unit of inventory. So we take 40 times 10.38 plus 400 times 13, take that entire quantity and divide it by 400 plus 40, which gets us $12.76 per unit. So that makes 440 units at $12.76 per unit. The 440 units came from 40 units in our previous balance of inventory, plus the 400 purchased on January 19th. Next, on January 21st, we have a purchase of 110 units at $15 per unit. Since we have a purchase, we can record these units in the purchase column. Moving on to the inventory column, we had a purchase, so we need to calculate a new cost per unit of inventory. This might be a good time for you to pause the video to see if you can calculate the new cost yourself, so I'll give you a moment to try it out. Okay, now that you've given that a try, the correct inventory balance for January 21st is 550 units at $13.21 per unit. The work is on the screen if you got stuck. Finally, on January 23rd, we have a sale of 510 units, which means we get to use the cost of goods sold column again. We already did the hard part of calculating the cost per unit on January 21st, and now we can use the inventory cost of $13.21 to record the 510 newly sold units. Now we need to calculate the January 23rd inventory. Since cost of goods sold is minus, we take our previous inventory of 550 units and subtract the 510 that we sold, leaving us with 40 units at $13.21 per unit in ending inventory. Alright, we have done the hard part. All that's left is to calculate the cost of goods sold and the ending inventory. To calculate the cost of goods sold, we simply multiply the units and the cost for each row of the cost of goods sold column and add them together. So that's 640 times 10.38 plus 120 times 10.38 plus 510 times 13.21 equals $14,626 if we round to the nearest dollar. Thankfully for inventory, all we need to do is calculate the balance as of the final date, which is January 23rd. So that's 40 times 13.21 equals $528, again rounding to the nearest dollar. So technically we are done. The cost of goods sold is $14,626 and the ending inventory is $528. But there's one more step we can take to check our work. We can calculate something called the cost of goods available for sale, which is simply the beginning inventory plus all purchases. So that's 500 times 10 plus 300 times 11 plus 400 times 13 plus 110 times 15 equals $15,150. Now, if we take the cost of goods sold of $14,626 and add that to the ending inventory of $528, we get, well, $15,154. And ideally this would add up to the cost of goods available for sale of $15,150, but since we rounded our inventory cost to 2 decimals, we lost some of our precision, causing us to be off by a few dollars. As long as you're following the rounding conventions from your instructor, then being a few dollars off shouldn't be a problem.